We have officially entered the acceleration phase. For months, we warned that the suppression of the silver price was becoming mathematically impossible to sustain. We warned that the paper contracts on the comics were trading on borrowed time, and that when the physical reality finally asserted itself, the move would not be linear. It would be vertical. Today, Tuesday, January 13th, 2026, the vertical move began. Look at the 30-minute intraday chart. This is not a normal trading day. This is a liquidation event. The price of silver has surged to, we have officially entered the acceleration phase. For months, we warned that the suppression of the silver price was becoming mathematically impossible to sustain. We warned that the paper contracts on the comics were trading on borrowed time, and that when the physical reality finally asserted itself, the move would not be linear. It would be vertical. Today, Monday, January 12th, 2026, the vertical move began. Look at the 30-minute intraday chart. This is not a normal trading day. This is a liquidation event. The price of silver has surged to $84.98, a move of over 6.1% in a single session. But the percentage gain is the least interesting part of this story. The real story is how we got here. To understand the violence of today's move, you have to look back at the bear trap that was set on January 9th. Look at the V-shaped recovery on the chart. The banks managed to smash the price down to $74. They flushed out the weak hands. They triggered the stop losses of the retail traders who were overleveraged. They wanted you to believe the rally was over. They wanted you to believe that silver was heading back to $60. That drop to $74 was the fuel. Every short seller who piled in at that level is now underwater by $11 an ounce. They are trapped. And today the trap snaps shut. Follow the price action from the Sunday open. We gapped up from $80 to $80. That gap, that empty space on the chart where no trading occurred, is a sign of extreme aggression from the buyers. It means they were not willing to wait. They were not willing to negotiate. They just hit the buy button at any price. And then look at the overnight session leading into this morning. You see the staircase pattern up, consolidate, up, consolidate. That is not retail money. That is institutional accumulation. That is a sovereign wealth fund or a massive industrial buyer patiently absorbing every single ounce that came onto the market. They were building a position. They were soaking up the float. But then at 8:01 this morning, New York time, the patience ran out. Look at the vertical green candles on the right side of the chart. That is the moment the United States market woke up. That is the moment the algorithms in New York looked at the price in Shanghai and realized they were mispriced by nearly $8. This triggered a panic chase. The volume bars exploded. Here is the merged version where I combined each group of 3 short consecutive lines into one single line, without changing any words, only removing line breaks and adding spaces where needed for readability. The price ripped through $84 and didn't stop until it hit $85.32. Notice the lack of a wick on that final candle. In technical analysis, when a candle closes at its absolute high, it means there was zero selling pressure. It means the buyers were willing to pay the highest price on the board just to get in. It is a sign of total desperation. This is what a commercial short squeeze looks like in real time. The banks that were short at $74 are now facing margin calls in the billions. The clearinghouse computers are taking over. They are closing the losing positions at market price. They do not care if the price is 85 or 95. Their only instruction is to close the trade. However, we must remain level-headed. We must anticipate the counterattack. Whenever market moves this fast, volatility expands. We are now in a trading environment where a $2 or $3 swing is just noise. The banks will try to engineer a flush. They will try to drop the price back to $82 to retest the breakout level. If you see silver drop $3 tomorrow, do not panic. Do not sell your position. A pullback to $82 would simply be a backtest. It would be the market checking to see if the previous resistance has turned into support. It is healthy. It allows the moving averages to catch up to the price. But here is the danger of waiting for a dip. In a true supply crisis, which is what we are witnessing, sometimes the dip never comes. Sometimes the market goes limit up. This means the exchange halts trading because the price is moving too fast for the clearinghouse to calculate the margin. If the market locks limit up, you cannot buy. You're frozen out. The train leaves the station and you're left on the platform holding depreciating fiat currency. This $85 level is critical because it represents the point of no return for the commercial shorts. Above $85, the losses on their books become existential. They move from trading losses to solvency issues. This is why the battle at this level is so violent. They are fighting for their lives, but the chart tells us they are losing. The trend is exponential. The dips are being bought faster and faster. The paper game of price suppression relies on the ability to flood the market with contracts. But today, the market absorbed those contracts and kept rising. The paper is burning. The physics of the market are taking over. So the technical verdict on January 12th is clear. The breakout is real. The $80 ceiling has been shattered. The $74 bear trap has been sprung, and the $85 level is now the new battleground. But charts only tell you what happened. To understand why it is happening and where the price is going next, we have to look across the ocean. We have to look at the magnet that is pulling the price higher. The chart says $85, but the real price, the price that matters, is sitting nearly $8 higher. In the next section of this deep dive, we are going to analyze the Shanghai shock. We're going to look at the closing price from China today and why that specific number guarantees that the US price has to move higher. The arbitrage vacuum has opened and it is sucking every ounce of silver from the west to the east. The chart shows the panic. The next part explains the reason. While American traders are staring at their screens, mesmerized by the move to $85, the smart money is looking at a completely different number. A number that makes $85 look like a clearance sale. We have received the closing data from the Shanghai Gold Exchange for Monday, January 12th. While New York was waking up, China was closing out its trading day. And the number they printed is the most dangerous data point in the global financial system right now. The Shanghai silver benchmark closed its afternoon session at $93.31. Let that sink in. $93.31. This is not a futures contract for delivery next year. This is the spot price for physical metal in the largest manufacturing hub on the planet. This creates a massive, undeniable distortion in the market. Right now, as you watch this, there's an $8 spread between the price of silver in the West and the price of silver in the East. In the world of high-frequency trading, where algorithms fight over fractions of a penny, an $8 spread is not an opportunity. It is a black hole. It is a vacuum that sucks matter into it with irresistible force. This is the arbitrage vacuum. Here's how it works and why it guarantees that the US price must move higher. If you are a global bullion bank or a trading house like Glencore or Trafigura, you see silver sitting in a vault in New York priced at $85. You see buyers in Shanghai screaming for metal at $93. What do? It is the easiest trade in the world. You buy the metal in New York, you put it on a plane, you fly it to Shanghai. You sell it for $93. Even after paying for fuel, insurance, and security, you are making a risk-free profit of $6 or $7 per ounce. This trade is happening right now. Every available ounce of silver in London and New York is being palletized, wrapped in plastic, and shipped east. This creates a drain. It drains the liquidity from the Western markets. The Conk's inventory, which is already at historic lows, is bleeding out to feed the Shanghai premium. The banks in New York have two choices. Choice one, they can let the arbitrage continue until the vaults are completely empty, at which point they have to declare force majeure and default on their contracts. Or choice two, they have to raise the price in New York to match the price in Shanghai. They have to close the gap. This is why I call $93 the magnet. The price in New York is not rising because of speculation. It is rising because it is being pulled. It has to rise to stop the bleeding. If silver in New York stays at $85, the United States will have zero silver left in a matter of weeks. We are witnessing the remonetization of silver led by the East. For decades, the price was set in London and New York by paper derivatives. China took the price. They were price takers. Today, on January 13th, that dynamic flipped. China is now the price maker. They are bidding the price up because they need the physical metal for their solar panels, their electric vehicles, and their strategic reserves. They are willing to pay a premium to secure the atoms. New York is now the price taker. We are just trying to keep up. The vertical candle we saw at 8:30 this morning was simply the New York market realizing it was priced too low. It was a game of catch-up, and the game is not over until the prices converge. This means that even if we see a pullback in New York, even if the banks manage to smash the price down to $82 tomorrow, the floor is solid. Because at $80, the arbitrage gap widens to $11. The incentive to ship metal to China becomes even stronger. The drain accelerates. So the lower the price goes in New York, the faster the physical metal disappears. This is the trap the short sellers are in. If they smash the price, they lose their inventory. If they let the price rise, they lose their money. There is no way out. And we must ask the question, why is China paying $93? Why are they panic buying? It brings us back to the concept of inelastic demand. The Chinese economy is pivoting to high-tech manufacturing. They dominate the global solar panel market. They dominate the global battery market. These industries cannot function without silver. We know from our previous reports that industrial stockpiles are critically low. The just-in-time supply chain has shattered. Chinese manufacturers are moving to a just-in-case model. They are hoarding. If a solar manufacturer in Shenzhen thinks silver is going to $150 next year, paying $93 today is a bargain, they are not speculating on the price. They are securing their survival. They are locking in their raw materials before their competitors do. This industrial hoarding creates a floor under the price that is made of concrete. You cannot shake out a buyer who needs the metal to keep their factory open. They will not sell if the price drops. They will just buy more. This is fundamentally different from a speculative bubble. In a bubble, people buy because they think they can sell it to a greater fool next week. In a shortage, people buy because they intend to use it. The $93 price in Shanghai is the real price. The $85 price in New York is the paper price. The gap between reality and paper is where the opportunity lies. But there is another layer to this. It is not just about industrial demand, it is about currency defense. The yuan is weakening. The Chinese citizens are seeing their property markets crumble. They are looking for a place to hide their wealth. They cannot buy dollars easily due to capital controls, so they buy gold. And when gold gets too expensive, they buy silver. The premium in Shanghai is partially driven by a flight to safety from the Chinese public. They are voting against their own currency. And in doing so, they are breaking the suppression mechanism of the Western banks. So when you look at your screen and see $85, do not think it is high. Think it is cheap. It is trading at a discount to the global clearing price. You're being given a window of opportunity to buy silver at a price that is lower than what the manufacturers in China are paying. That window will not stay open forever. Arbitrage windows always close, and they usually close violently. We expect the volatility to continue. We expect the banks to fight this trend with everything they have, but they are fighting gravity. They are fighting the flow of physical matter. The magnet at $93 is pulling us up. And once we hit 93, the next magnet will be 100. But while the charts and the global arbitrage explain the macro picture, there is something happening right here in the United States that is even more immediate, something that affects you directly if you are trying to buy metal today. While the paper price is $85, the street price in America has completely decoupled. We have received reports from major U.S. bullion dealers that confirm the supply chain has snapped. In the next part of this deep dive, we are going to look at the dealer crisis. We are going to discuss the explosion in premiums, the 8-week delivery delays, and the terrifying quote from a U.S. bullion executive that confirms nobody has any silver. The arbitrage isn't just happening between New York and Shanghai. It is happening between the comic screen and your local coin shop, and the spread is blowing out. The charts tell you where the price was. The dealer tells you where the price is. In part 1 and 2, we analyze the global macro forces, the Shanghai magnet, and the industrial panic that are pulling the paper price of silver higher. But for the individual investor sitting in the United States on this Monday morning, January 12th, there's a much more immediate and terrifying reality unfolding. We have received confirmed reports from major U.S. bullion dealers that the physical supply chain has snapped. Now, while the ticker on CNBC says silver is trading at $85.37, the reality on the street is completely disconnected. If you try to buy a silver round or a silver eagle today, you are not paying $85. You're paying a premium that we have not seen since the height of the pandemic squeeze. Premiums on standard silver rounds have exploded to between $8 and $9 over spot. Let's do the math. $85.37 plus $9 equals $94.37. This is the real price of silver. Notice something fascinating. The street price in America, $94, is almost exactly aligned with the Shanghai price of $93.31. The physical market has already repriced. The physical market has already crossed the $90 threshold. The only thing that hasn't caught up is the paper contract on the comics. The screen is a lie. The receipt from the coin shop is the truth, but the premium is only half the story. The price is high, yes, but the availability is the real crisis. We are receiving reports that private mints, the companies that take the 1,000-ounce industrial bars and turn them into the coins you can buy, are currently quoting an 8-week delay on new orders. 8 weeks, 2 months. This is not a shipping delay. This is not because FedEx is busy. This is a manufacturing failure. It means the mints cannot get the raw silver blanks or planches required to stamp the coins. When a mint tells a dealer there is an 8-week delay, they are essentially selling a futures contract. They are saying, give us your money today and we hope we can find the metal to ship to you in March. This is a sign of a physical default at the retail level. The inventory buffer that usually sits between the wholesale market and the retail buyer is gone. It has been vacuumed up by the panic buying of the last 48 hours. We have a quote from a senior executive at a major U.S. bullion dealer that chills the blood. When asked about the inventory situation this morning, he stated simply, "Nobody has any silver." He went on to warn that if the momentum continues, silver round premiums could go to $20 or $30 per ounce here. Think about the implications of a $30 premium. If the spot price stays at $85, but the premium hits $30, the cost to you is $115. This creates a bifurcated market. It means the paper price becomes irrelevant to the physical holder. The banks can smash the paper price all they want. They can print infinite contracts to drive the comics price down to $70. But if the physical premium rises to $50 to compensate, The price you pay is still $120, but you cannot print physical metal. You cannot short a silver eagle into existence. This disconnect is dangerous for the banking establishment because it exposes the fraud. It proves that the COMEX is no longer a valid price discovery mechanism. It is just a casino for high-frequency trading algorithms, and the public is waking up to this. The retail tsunami we predicted is hitting the shores. The reason premiums are exploding is because the average American investor realizes they are behind the curve. They see the headlines, they see the inflation, they see the debt, and they want an asset that is real. But when they go to buy it, they are finding empty shelves and massive markups. This creates panic buying. In a normal market, when the price goes up, buyers step back. They wait for a deal. In a shortage, when the price goes up, buyers rush in. They are afraid that if they don't buy at $95, they will have to buy at $150 next week. Or worse, that there will be nothing left to buy at all. This is inelastic demand, meaning inelastic supply. The mints cannot speed up production because they cannot get the silver. The buyers will not stop buying because they are terrified of the dollar. Something has to break, and that something is the price. The paper price must rise to meet the physical price. The COMEX cannot trade at an infinite discount to reality. If the spread gets too wide, traders will stand for delivery on the COMEX, take the bars at $85 and sell them to the mints at $95. This arbitrage will drain the COMEX vaults until they are empty. It is a mathematical certainty. So what should you do in this environment? If you're looking to buy physical metal, you are in a difficult position. You are paying a massive premium. You are locking in a loss relative to the spot price immediately. But you have to ask yourself, is it better to pay a $10 premium and have the metal, or wait for the premium to drop and risk getting nothing? If the executive is right and premiums go to $30, then paying $9 today is a bargain. This is the unobtainium phase. The price on the sticker doesn't matter if the product is out of stock. We are seeing the early stages of a run on the bank. But it is not a run on a commercial bank where people want their cash. It is a run on the resource bank. People want to exchange their cash for resources before the resources are repriced to infinity. The 8-WE delay is the tell. It signifies that the system is stressed to its breaking point. If that delay stretches to 12 weeks or 16 weeks, the market effectively freezes. At that point, the price becomes no offer. You cannot buy silver for any amount of paper money. You can only buy it with other assets. You can only buy it with gold or land or labor. We are not there yet. You can still buy silver today. You can still place an order, but the window is closing, the doors are shutting. The dealer crisis is the canary in the coal mine. It is telling us that the wholesale market is broken. If the mints cannot get silver, it means the refiners cannot get silver. If the refiners cannot get silver, it means the miners are tapped out. The chain is broken. And while the dealers scramble, the chart continues to paint its vertical masterpiece. 85.37 up nearly 7%. The paper game is trying to pretend everything is normal, but the physical game, the game of premiums, delays, and shortages, is screaming that the system has failed. In the final part of this deep dive, we are going to look at the end game. We are going to take the $93 Shanghai price, the $30 potential premium, and map out where this rocket ship is actually heading. We are going to discuss the psychological barrier of $100 and why hitting that number will trigger a global media frenzy that makes the current panic look like a dress rehearsal. And I'm going to give you the final verdict on how to navigate a market where the price and the value are two completely different things. The dealer has spoken. Nobody has any silver. If nobody has it and everybody wants it, what happens to the price? You know the answer. We have arrived at the conclusion. If you have been with me through this entire deep dive, you now understand the full scope of the fracture. You understand the technical breakout on the charts. You understand the Shanghai magnet pulling the price to 93s. And you understand the dealer crisis, where the physical street price is already decoupled from the screen. The evidence is overwhelming. We are not looking at a trading anomaly. We are looking at a systemic failure. The trifecta of price discovery, the technicals, the arbitrage, and the physical supply have all aligned in a way we have not seen since 1980. Now, we must look forward. We must map out the territory that lies ahead. Because once an asset breaks its all-time high, once it enters price discovery, there are no maps. There are no resistance levels on the chart because we have never been here before. We are flying into the vacuum. So where does this stop? Is $85 the top? Is $93 the top? Is $100 the top? To answer that, we cannot look at the dollar price. As we have established, the dollar is a broken yardstick. Measuring silver in dollars is like measuring the length of a bridge with a rubber band. The rubber band is stretching, so the bridge looks longer every day. Instead, we must look at relative value. We must look at their relationship between the two monetary metals, gold and silver. Look at the price of gold today. It is trading around $4.65 for $1. It is up over 2% on the day. It is holding firm. It is the anchor of the new financial system. Now let's look at the gold to silver ratio. Throughout monetary history, from the Roman Empire to the United States Constitution, in the modern era of manipulation, that ratio blew out. It went to 80, 90, even 100 to 1. This was a sign of extreme suppression. It meant silver was being priced as a cheap industrial byproduct, not a scarce monetary asset. But today, with gold at $4,600 and silver at $85, the ratio is approximately 54 to 1. The ratio is collapsing. It is reverting to the mean. If silver were to simply return to its historic monetary norm of 15:1 against the current price of gold, where would it be? Do the math. 4,605. 15. $37 per ounce. $37. That is the fair value of silver in a world where gold is $4,600. At $85, silver is not expensive. It is on sale. It is trading at a 70% discount to its monetary parity. This is the catch-up trade. The algorithms know this. The central banks know this. When gold gets too expensive for the average person, capital flows into silver because it is the poor man's gold. It offers more leverage. It offers more upside. This is why I believe the move to $100 is not a question of if, but when. The Shanghai price is already at $93. The street price with premiums is already at $94. The paper price has no choice but to follow. $100 is the psychological barrier. Humans love round numbers. When silver crosses $100, it will trigger a global media frenzy. It will be on the cover of Time magazine. It will be the lead story on the nightly news. That is the moment of maximum danger and maximum opportunity. This brings us to the exit strategy. I know many of you are thinking about selling. You look at your stack. You calculate the value in dollars and you feel rich. You think, I can pay off my house, I can buy a new car. But you have to be very, very careful. If you sell your silver for dollars, what are you actually doing? You are trading a hard asset that is appreciating for a soft currency that is collapsing. You are jumping off the lifeboat and swimming back to the Titanic because the Titanic has a minibar. The dollar is not the destination. The dollar is the victim. We are living through a currency reset, but it is not a reset announced by a politician at a podium. It is a reset driven by the market itself. The signal isn't a bond sale. The signal is the spread. When Shanghai pays $8 more than New York for the same ounce of metal, the market is screaming that the Western financial system has lost its pricing power. The paper game is ending because the physical inventory is gone. In every currency collapse in history, from Weimar, Germany to Zimbabwe to Venezuela, those who sold their gold and silver too early regretted it. They sold for millions of paper units only to find that a loaf of bread cost billions of paper units a month later. So when do you sell? You sell when you can trade your ounces for income-rousing hard assets. This is the ounces to acres strategy. Do not trade your silver for paper. Trade it for land. Trade it for a rental property. Trade it for a business. Trade it for energy infrastructure. Wait for the moment when the mania is so high that real estate prices have crashed relative to silver. Right now, it might take 5,000 ounces of silver to buy a decent house. In the peak of a mania, it might take 500 ounces. That is the trade. You're swapping one form of generational wealth for another form of generational wealth. You're bypassing the fiat currency entirely. But we are not there yet. We are at $85. We are just leaving the launch pad. The week ahead is going to be the longest week of your financial life. The volatility will be nauseating. The banks will launch counterattacks. They will try to smash the price down to $80 to trigger stop losses. They will spread rumors of a ceasefire or a bailout to try and calm the market. Ignore the noise. Watch the flows. No. Are the mints catching up on the 8-week delay? No. Is the industrial demand for batteries slowing down? No. The fundamentals are locked in. The bridge is burning behind us. There's no going back to $20 silver. That world is gone. We're entering the era of resource nationalism. Countries that have silver, like Mexico and Peru, are going to start hoarding it. Countries that need silver, like the US and China, are going to fight for it. You, the individual investor, are standing in the middle of this geopolitical brawl, holding the only thing everyone wants. Do not let them shake you loose. Hold your position. Secure your vault. Educate your family. The great repricing is not just about getting rich. It is about surviving the transition from a debt-based economy to a resource-based economy. The dollar died on Sunday. The price discovery began on Monday, and the future belongs to those who hold the physical reality in their hands. Stay safe, stay liquid, and welcome to the age of real money.